Okay, welcome everybody. This is an interesting and very timely video for a lot of people. And the subject today is pullback trading strategy. Why? Well, because we're in the midst of a Bitcoin pullback, and that is the number one query we've received lately. A lot of people are stressed out. A lot of people are feeling the pressure of this pullback. But I think we're here to tell you that, well, it does kind of suck. You know, your equity is going to go down because the value of the underlying asset is going down. And, you know, you might be long calls, you might be long futures, you might be long the underlying, you might have sold puts, you might have done all kinds of things that put you long the market. Those are all suffering right now. And you're feeling that. And I get it. And we're in an interesting situation because if we were trading any other time, any other asset, you know, we're generally sort of neutral. We don't know if things are going to go up or down. Sometimes we've got inclinations and slight biases that will take those biases. But for the most part, we're trying to stay relatively neutral. We're not trying to stay neutral right now in Bitcoin. Why? Because we know what's happening. We know the ETFs are buying. We know how many Bitcoin are being mined. We know the halving is coming up. We also know there's selling going on. There's outflows from Grayscale. There's miners who need to raise some money. There's all kinds of market dynamics, but long term, this doesn't change anything. And let's put things in perspective. We're up to what, 75, 76,000, something like that. We've pulled back. You know, the total length of the pullback, which is last night, the low of around 60,700, or could go lower, but that was the recent low. That was about 15%. If you've been paying attention, if you've been in the crypto space for any length of time, you know that 15% pullback is child's play.
That would be a small one for a pre-halving pullback.
Yeah, and here's the thing.
In the people say historically in Bitcoin when they mean 4 sample cycles. It's not really a history, but with the limited history we have, it's not unusual to have a pullback before halving.
Yeah, and you know, we get about a 10% pullback every 90 days, and it was just under normal circumstances. Never mind these circumstances. Now, we knew a pullback was coming. We didn't dare try and time it. You know, it could have went to 100K and then pull back to 75 or 70. You know, that would have been a monster pullback. That would have been, 25, 30%. Who knows? Who knows when these things are going to happen? The only thing I can say is that you got to expect them, and you have to expect that during those times, your account equity is going to look crappy. But the important thing is this. We could wake up tomorrow and Bitcoin might be at 50,000, might be at 40,000. Who knows, right? It's going to suck, but it's not going to change our long-term bias. So what's our strategy to deal with this when we're trying to stay long in a market that's declining? It's counterintuitive. We wouldn't normally do this. We would just say, hey, you know what? The market's going down. Let's go down with it for a little while. Okay, it's slowing down. Let's get neutral. Maybe go up with it. We're only staying long because of these long-term dynamics that are at play. So how do we play this? Well, first of all, we're going to stay calm. We're just going to adjust as necessary. So depending on what type of trading you're doing, if you're leveraged to the max, that's not the way to trade, right? We see how many liquidations happen on every one of these pullbacks. People are getting burnt. They're trying to time the market. They're trying to catch a bottom.
It's like standing in the way of a tsunami, right?
Yeah, you can't time, but every now and then you might get lucky and grab the exact bottom or top. Kudos, wonderful. But if you're in the business of trying to do that, you probably won't have a very long trading career unless you're like a super scalper. You're highly intense. You've got a lot of tools. Those people make a living at it. But for most people, you're probably not going to be right. And the market shenanigans will last longer than you can probably stay solvent. So the point, or the best thing to do, is make sure you have available margin. Now, we're options traders, right? So you want to make sure you have available margin. So if you have to adjust, you adjust. Let's say it does go down to 55 tomorrow. It's going to suck, but what are we going to do? We're going to adjust some of those in the money puts or near the money puts or ones that are coming near the money. Everyone is a little bit different on how they want and when they want to adjust those. We're going to roll those out of the way. We might buy some more futures. We might even be short futures for a period of time. But as it starts to go up, we're going to ensure that we're long with the market. Now, here's just one little piece of food for thought. If you're running an ETF, Let's say it's a gold ETF. Doesn't matter what it is. Doesn't matter what the underlying asset is. If the price is in a big skid, do ETFs buy more aggressively or less aggressively? Well, they buy less aggressively as it goes down because they're against the trend. They don't know. They're okay to dollar cost average in, get a little bit lower. But when the price starts to go up, when they're in an uptrend, that's when they buy more aggressively. They got everything's on their side. They're with the trend, right? They're not trying to. They're not going all. You know?
Fewer people buy ETFs when prices are going down because people's investment behavior is counterintuitive.
Yeah,
people respond to sentiment rather than logic.
So when it comes down to strategy, it's going to completely depend on the type of trader you are, how you're trading the market, your risk tolerance, and the products you're trading. If you're just buying spot or you're just buying the underlying, well, that's kind of a no-brainer. You're either just going to hang on at whatever price you're in, or maybe you're going to slightly average in, dollar cost average in, have some orders layered in on the downside, maybe orders layered in on the upside. So if it starts to go up, you buy a little bit more. It's pretty simple if you're just holding the underlying and your long-term view is that it's going to go up. Hey, you think it's going to be at 100K, within 6 months or the end of the year, or whatever your target happens to be. It gets a little bit more complicated if you've got an options book. So all you want to do with the options book is take care of the things that are causing you a problem and either move them away into the future or lower in price if they're in the money puts. And you can store that value in the future. If you follow our live streams, you'll see us do that all the time. Something, an underlying asset moved a little bit too much, we weren't quite expecting it. We'll take that value and just plop it in the future, maybe a few months down the road, and we'll look to bring it forward later when conditions are favorable to do so. You can do those things with options. That's a great thing. Again, when you're trading options as an option seller, you're not going to see your account just go up forever. That's unrealistic. It does this. There's going to be declines in equity, and it sucks. When you've got everything pointing long, you're bullish on everything, and the underlying asset is coming down, right? Your equity looks like crap. Again, you just keep your margin under control, and it allows you to wait. Now, I'm not saying the hope and wait strategy, that's stupid for most investing. This is a special situation with Bitcoin because we've got this long-term view, and we've thought, look at all these things that are happening. It only makes sense that it's most likely going to go up. This is different. It's not like we're trading oil. The price of oil could stay down for years. We saw it go down to zero before. This is a different entity. So in terms of strategy, Richard, specific strategies for people, what would be your advice?
Number one, take less risk than you did. So the temptation with options, particularly if the markets are sort of calm and volatility is high, the temptation is to ape in, to pick up all the vol. And often that's a good strategy on an index or something sort of calm in normal times. And then you've got Bitcoin, which is, as we've always said, 30 years of trading compressed into 3 months, every 3 months. So you get, 3 bull and bear markets, massive volatility swings, massive liquidations, things that would be considered on Wall Street to be Great Depressions, and they are just normal in Bitcoin. Don't run of the mill. So the implication there is that on the good plus side, there is going to be huge volatility. You're trading on average 70% vol asset anyway, so you don't need much leverage to do well when the market's going up. And if you're selling, say, 80 vol, and then buying back at, say, 50 vol, and then selling again at 80 vol and buying back at 50, you don't have to do that many times with much premium to put in quite a good return. And let's also remember that actually, if we make, say, and particularly on Bitcoin, if you have the Bitcoin thesis, you believe the Bitcoin thesis that it is going to go up over time, then you don't actually have to make that many Bitcoins to do well, because you're going to benefit from the increase of the underlying asset as you accumulate them through options trading. So if you were to make, say, 1% a week in your number of Bitcoins, I'm that's 50% a year. And if you're of the view that Bitcoin's going to go up, let's say 100% a year, as say Michael Saylor or Cathy Wood is of that view, then that's 50% on top of 100%. That's whatever that is, 150% a year. That's more than enough, right? Your investment horizon should be for the rest of your life. You shouldn't be trying to just get rich quick, because that never works. Well, sorry, it doesn't never work. It sometimes works, but more often than not doesn't. So if you give yourself, let's say a 10-year investment horizon, or even a 4-year investment horizon, aim to make 1% a week if you can on average. You'll be amazed at how quickly that compounds up. And so and in fact, at those kind of levels, pullbacks like this, you will barely feel them.
Yeah, and depending on if you're already in the market or how deep you're in the market, this could be a golden buying opportunity. Who knows? Maybe it'll go lower and maybe it'll be better. I don't know. But it's important to stay fluid to ensure that another 10% isn't going to wipe you out. Just one thing I'll just clarify too. So for a lot of people who either don't know about options or are very retail trader, very, very simplistic on options, there's nothing wrong with that. Richard is more likely to trade based on the implied volatility of an option versus its price. Now, retail traders will think, hey, I'm going to sell the 80,000 call and I'm going to buy the 90,000. They'll think in terms of price, and that's okay. But you have to recognize the importance of implied volatility, because a lot of times, you might sell an option. Let's just say it's the 80,000 Bitcoin call option for the end of April. And, if you're selling that call, you ideally want the price to stay under 80,000 or go down so you can buy it back cheaper. Well, sometimes you'll see the price go down from where you sold it, but the option gets more expensive. Well, that's the effect of volatility. An increased volatility plays a major part in an option's price. So a lot of times you'll see professional option traders simply quote the volatility versus the price. Now, it's good to keep them both in mind, I think, for retail traders, and that's something we help people do. But you have to be aware, especially with Bitcoin, we get really large swings, not only in price, but in volatility. And we see before the ETF announcement, we see, we'll see before the halving, we'll see volatility increase, just like you would in a stock. When earnings is coming up, volatility will go up through the roof because there's a lot of uncertainty. People who are selling our options are saying, hey, I don't know where the price is going to be. I want more money. If I'm going to take on that risk, I want more money for it. So that's just a normal market condition. Just wanted to clarify that.
Yeah, I think it's worth saying that I do look at the strike price, because I do mentally think, do I believe the market's going to get there? Not that that means anything, because my prediction power is zero compared to the market. But there's a sense of comfort from that. But also, am I getting enough money for the risk of that strike? And that is entirely down to the implied volatility. And if I'm selling, let's say, a 100-volt option on Bitcoin, then I'm feeling much more comfortable than if I'm selling a 60-volt option or definitely a 40-volt option. And so really, last year was a bit of an anomaly where vols were down to sort of 35.
During the summer,
did nothing through. And you can go broke really quickly just buying volatility for a long period of time. But now that markets have sort of spiced up, then you really don't want to be, aping into vol that's kind of below probably 70 or 80. And if you get vol that's down at 50, you probably want to be buying it back. Even if you didn't realize all the money out of the option that you sold, because it's another dimension of risk that you don't want to take, right? If vols have dropped that much, take the profit, wait a week or two, something will happen, and you can get back in. You don't have to get all the money tomorrow.
Yeah, and we can even I'll quickly just share my a chart. Let me just bring this up. Just so we get an idea of perspective here. This is a daily chart. Let me go to it. Well, we can look at a daily chart. That's fine. This is 2024 right here. So we've had this big run up. We've had this pullback. It is a pretty big pullback on a chart, but it's in the big picture, considering the size of the run up all the way from here to here, that's nothing really. People need to expect and understand that the market's going to have this. And if we want to look from a technical standpoint, look, we're hitting an EMA right down here, right? We're at the bottom of this previous resistance zone. Now, I don't want to go through all this because this is more something that we share with our members, and it's maybe a little bit out of context right now, but it's not that big of a deal. Could we keep going down a little bit more? Sure, why not? It's possible. I don't think it's going to go down a lot more. There's a lot of invested interest. You've got Michael Saylor, you've got BlackRock. You've got a lot of these people who have bought at higher prices. Doesn't mean it won't go down. So if we're talking specific strategy, it depends. There's so many variables here. But let's just say you're jumping into the market. Maybe you've got a little bit of Bitcoin. Who knows where your average price is? If you thought the bottom was maybe around this area, but you have to be prepared that it might go 5% lower, 2% lower. It might go 15% lower. Who knows? But you're okay to start to chip in right now. You can buy the underlying. You can buy futures. I wouldn't recommend perpetuals because they're incredibly expensive, the funding rate. You can buy calls. You can buy a call spread, which would be buying a call and selling a call at a higher price to offset some of that cost. You could do that as a 1x2 where you offset all of the cost, but you have a little bit of naked exposure at the top. Or one of the things we love to do is we'll buy a risk reversal. We'll sell a put in order to fund the cost of buying a call. So it makes it free, or maybe a slight credit, or maybe a slight debit. It just depends on the strike prices and the expiries. These are things you can start to do. So let's say you're wrong. Let's say you think, you know what, Shane, that's a good idea. I'm going to sell the 58,000, April, and I'm going to buy the 64, the call. So you're selling the 58,000 put. So you don't want the price to go below 58,000. You're buying the 64,000 call, thinking, "Yep, hey, we're going back up in the 70s, 80s. Woohoo! The sky's the limit." Great, you can do that. But what if it goes wrong? What if the price goes down and starts going down to the 50s? Okay, no problem. What we're going to do is we're going to manage that put. We're going to buy it back at a loss, and we're going to roll it down in time, or we're going to roll it sideways, just out further in time and down in price, or just if we're going sideways, we'll keep it the same strike price if you think that's the bottom, but we'll just give ourselves more time. We'll collect a premium, or we'll do it for a flat trade. We can also get down. We can go down out in time on 1 month and down a few $1,000s. Give yourself more space, more space, more space. You can continue to do this as long as you have margin. So you don't want to go all in at any one time. As Richard said, if you over leverage, if you go in too hard, if you bring on too much risk, the market has a way of hunting you down. So just scale in, be gentle, make sure it goes up, you're going to profit. Wonderful. That's okay. But if you're going all in at one price, that's a rookie mistake. And you're asking, all we need is one big liquidation candle and you're flushed. And then you're out of the game.
Yeah, there's a whole lot of stuff we could say about timing the market. Actually, there's a lot of data in the cryptocurrency markets, in particular the Bitcoin market, that's not available readily to investors in other asset classes without paying huge fees to people like Bloomberg and Reuters and so on. And one of the most interesting measures is the level of relative leverage. So the ratio of open long futures to open short futures contracts, which gives you an indication of the level of sort of optimism and greed in the market. To a degree, it also means that people are hedging short calls and so on. But you tend to find that when that ratio gets particularly high, i.e., many more longs than shorts, then any pullback is going to be more violent. And when that is more neutral, pullbacks will be more gentle. And if the market's really bearish and there are many more shorts than longs, then any reversal is going to be violent too. Mm-hmm. And it's worth just bearing that in mind. If you're chasing the market, rolling calls, whatever, getting longer futures, it's worth just having that tingling in the back of your mind, saying, you know what, everyone's doing what I'm doing, and eventually there's going to be no more buyers left, right? Even if we believe Cathie Wood that Bitcoin's going to be $1 million by 4 years' time, or Michael Saylor, who says it's going to be 4.7 million by 2030. Even if that's true, not going to be a straight line, and the more aggressively it gets towards that target, the more aggressive the pullback's going to be.
Yeah. And people have to understand that market makers and dealers provide an essential service in the markets. People sometimes like to vilify them because they'll push the price around. But let's face it, they need to make money. If they don't make money, there's no markets. They need to be able to stay alive in order to provide liquidity for the rest of us. So sometimes these moves will happen for various different reasons on the back end we don't see happening. And now they need inventory. We know that supply will soon be outstripped, or supply will be outstripped by demand. You know, there's only a certain amount of mining. The halving is coming up. So eventually, that's why we're staying long in a currently falling market, and it's only been falling for 2 weeks. So it's not like we're in this massive, long downtrend. You know, we could be up at 70,000 this afternoon for all I know, right? So who knows? But it's important to recognize that these dealers have an essential function in the market, and they needed to get some inventory back. And when you've got everyone and their mother and their uncle and their dog is long the market, they're bullish, you're asking for a flush, because guess what? Who's buying or who's selling to those people? The dealers. And they need to get some of that inventory back in order to carry on providing the liquidity to make the markets function. So
and they know they can get it back because somebody's going to move the market, and the market makers keep track of who's long and who's short. Well, not necessarily who, but how many are long and short. They've got perfect data. They know exactly what the state the market's in and what it would take to cause people to go to liquidation. And that data is actually pretty much available anyway. Again, in crypto in a way that it is not in TradFi. So investors have to be very savvy and be aware of this, right? If you're gonna get leverage, if you just stick to 2x leverage and just stay long, you probably never have to worry, right?
Yeah. Hey, one thing I do want to clarify. I realize I said when it just floated a few ideas for being long the market or starting to scale in right now. I did say that we buy risk reversals. I want to clarify that in Bitcoin, we're not just going to sell that put naked. We'll do that as a spread. Okay, so just so we're not going to leave that put uncovered, just in case somebody's out there saying that sounds really risky. That would be risky. There might be times when we do it, but generally, I'll always advise people to cover those puts, and we would normally cover those puts anyways. And in fact, we usually double cover puts. And in a bull market, we're going to double cover calls too. That's why as the market tanks, what are we doing? Well, we're buying calls because they're cheap. When the market's ripping up, what are we doing? We're buying puts because they're cheap. They might be wasted money. They might but they might come in handy. We might build spreads out of them, might do all kinds of stuff. And if you follow our live stream or you subscribe to roguetrader.academy, you'll see how we do those things. But I think the long and short of it is, Richard, is this pullback is expected. I know a lot of people are in pain. Just simply adjust when you have to. Make sure you maintain some amount of free margins so that you can continue to operate and adjust when you need to. And I think it's really just a little bit of a waiting game for all the mechanics and metrics that are this crypto market to start to kick in and carry us forward. Now, whether we're going to stay down for the next 2 days or 2 months, I don't know. But the halving is coming in April. And I think I saw you post in one of our groups that it's been pushed forward to the 15th.
There's been so much mining activity. I think all the miners have switched on all their old kit and they're maxing out the amount of hash rate they're producing. I think to capitalize on the pre-halving returns. I think it's going to get half as profitable for miners. Well, sorry, it's going to be half as they're going to get half the return. Which means the profitability is going to quarter, if or worse.
And the other thing too is a lot of these miners are going to need to upgrade their equipment because of the halving. So they're selling coins because they need to buy new kit, and that's bloody expensive. And a lot of these operations are huge, as you can imagine. So they'd be spending millions on new equipment. So, any final thoughts before we take off?
No, something did occur to me. Something I used to do when trading FTSE was I would actually never leave strangles on if they were younger than a week or had less than a week to go. I know in crypto the temptation is always to sell super short dated stuff because you get massive premium decay per day. and things are a lot easier to roll if they're a bit further out than tomorrow, particularly if they're in the money. So it's something to bear in mind. I haven't done a lot of analysis of this on Bitcoin yet, but it's something that occurred to me today. So
fair enough. And we've got probably 100 or 1,000 little tricks and tips and things that we do a little bit different in crypto than we do in other markets, but not time to cover that stuff here. Again, you can always check out our live streams or join us at roguetrader.academy and join our conversation there. But anyways, I think that's it for today. Everybody stay calm, keep your powder dry in terms of margin available. And I think let's just wait this out and see what happens.
Mm-hmm.